Okay, good morning, everyone. Let's start our session today. The topic of the session is credit and inventory management. How the firms manage their credit and inventory so that they can increase their sales as well as they reduce their cost. So I divide this whole chapter into two parts. And the third part is in the shape of a one question or mm, two or three questions I'm going to do uh, separately. Maybe not on the team, but I'm going to upload it separately because the problem in the team is that when I write with the digital pen, uh, it's not recording that writing. So for that reason, I'm going to upload the question solution separately. So let's start credit and inventory management. That's the topic. And in this, what we're going to learn is that understand few firms manage their receivables and the basic components of a firm's credit policy. So that's a credit policy related to the credit offering to the customers, not to the borrowing uh, as a credit as a borrowing. So one thing. So how we allow the credit to the customer is through accounts receivable, that we sell the things on credit and later on we can recover the money from our customers. Know that distinct element of the terms of sale. Very commonly in accounting books and in our finance books, we see that there are terms like 2N 30 or 3N 10, 3N by 10. So we see that there's a discounts, like if you pay within 10 days, you will get a 3% discount. If you pay within 20 days, you get a 10% discount. Within 20 days, you get a 2% discount. And if you want to pay after these discount periods within that limit of a 45 or a 30 days, then you have to pay the net value. So these are the terms we cannot discuss. Understand the factors that influence a firm's decision to grant credit. Now, why the firm's going to offer the product on credit? This is also one of the reason or logic we're going to study in this chapter. Uh, know how to evaluate credit policy, evaluation of a credit policy, and understand the types of inventory and inventory management system used by the firms, and be able to determine the cost of carrying inventories and optimal inventory levels. So we also study in that there is a formula, or there's a model, quantity order quantity model. Uh, we apply to figure it out, and that's a topic from managerial accounting, but we are using here as to see that how this model is going to be helpful for a corporation to apply to their inventory management. So the first thing that we have to see is that uh, why do we grant credit, or why we want to sell the goods and services on credit? The one and the only reason behind this offering is to increase sales. To increase sales, because we know that there are many potential buyers. They are not buying right now because they don't have a resources, but later on they are able to pay. For that reason, we sell the things on credit. Now, when we sell the things on credit, we have already know that there is a possibility that few of the customers are not able to pay back. And that's the cost of the selling on credit, that there are some bad debts, there are some defaults that customers wouldn't be able to pay. And there is a second, that as long as the money is stuck in receivables, that is the amount we cannot use until and unless we receive it. So we can say that if we are selling things, we need a larger working capital as compared to if we are dealing in cash. So that's the point. So there are two types of cost. One cost is bad debts or uncollectibles or non-receivables. We can say that the failure of the customer to pay, that's the one. Certain percentages are very commonly on the average in different industries, like 3%, 2%, 1%. It's very. common that the customers are not going to pay. Then the second cost is that we the money we will get is after a 30 or a 45 days. So it means we have to bear the cost of this money which is held, that that the time value of money. So in this case, we lose that opportunity cost to use that money. And in a simple way, we can say that we need a more working capital to run our goods and services to sell on credit. Credit management examines the trade-off between, now why we need to manage the credit, because we have to trade off. What is the trade-off? We just discussed that the benefit is that we are able to sell more, revenue increase, and the cost is two types, like failure to pay or bad debts, and the other one cost is the wait time, or the time in which the money is stuck in receivables. So that's the cost, financing cost for that money, financing cost as well as the default cost. So altogether is the cost, and the benefit is that increase in sales. So we have to trade off that where is going to be better off, that we have a more benefit as compared to the cost. So normally, what are the credit policy components are? So we see that the terms of sale, credit period, cash discounts or discount periods, and then we have a type of credit instruments that we're going to use to allow them. Credit analysis distinguish between a good customer then that will pay and bad customers that will default. So normally every corporation has its own policy regarding to evaluate the customer before selling it on credit. So you can buy a lot of things on credit, like you can buy Apple products on credit, you can buy other products on credit. The way that they can do is that you have to first apply, and then uh, uh, they evaluate you on your credit scoring and all these things, and then they say, okay, you can buy it. But ultimately, at the back end, what they are doing, they are borrowing from some financial institutions like some banks. So they are just selling it on credit, and they recover the money from the bank. So they have to bear the cost of this time period financing, because they normally these firms, those who are directly selling, like an example of an Apple, they are not charging interest. So they are saying, okay, you can buy a product for 6 months or a year without interest. So they are bearing the cost of interest. Collection policy effect expanded on collection on receivables. So now, if you are selling things on credit, or then you must have a department, and the cost that also cost that who is going to pursue the customers for the payments if there is any delay, or if there is any not paying for an outstanding amounts. You have to continuously pursue your customers or follow back. So that needs a department to analyze the things and do corrective actions or actions at an appropriate time. So for a very traditional one, you see here that you sell, these are the timelines, or you can see there's a credit sale when at this time, and this is the point where you receive the cash in your bank account. So this whole period is called as an accounts receivable. With we are not talking here the default, but we are saying, okay, this is the time point where you are selling, and this is the time point where you are receiving the money. So this whole time, the asset is lying in your books as a receivable. Now this overtime can also be divided into another, which we call it as a cash collection, that you received a check mailed, check deposited, and cash in bank. So this is a collection time. Normally nowadays it's not like so big or to worry about, because the people are taking the e-banking facility or e-banking services to pay this or receive this cash. So by this way, there is this cash collection time is no more important nowadays. Terms of sale, normally, as I mentioned in the beginning, these are 210 net 45. It means that the terms of the sale is that if you want to pay, if you want to get 2% discount, you have to pay within 10 days. And if not, then you have to pay within 45 days. So it means that the credit is of a 45 days. If the customer is getting the discount or want to get discount, the customer has to pay within 10 days. Now, if we a 2% discount if paid in 10 days and total amount due in 45 days if discounts not taken. For example, in order to understand this, what is the opportunity cost of this uh, credit policy? So, for example, a customer buy a 500 worth of merchandise with the credit terms given above. Uh, Customer pays, if the customer pays within 10 days, then how much discount the person is going to get it? $10, 490. He has to pay 490. If you pay within 10 days, you will get it 490, right? And if they're going to pay off on a 45th day or a 45 days, then the amount is 500, right? Now, this is analysis like the credit terms are 210, net 45, and 500 loan. So 10 is the interest rate, $10 interest rate for 2%, which we calculated on 500. What is a period of rate or a period rate? This is a 10 over 490 because we can say that it is 2.048% is a period rate. And how much is the period? Period is 35 days because 45 days is the total for net amount. But if someone is availing on the 10th day, this $10 benefit, so the $10 is the cost that we are paying on the if the continue for 35 more days, if that continues for 35 more days. So 365 over 35 is equal to, this is the period per year we calculated, and we want to calculate effective annual rate. If we want to calculate effective annual rate, so this is the 1.020408. That is our interest rate, which we calculated here. Period rate. This is for 10 days. 2.0. So we 1 plus this interest rate, 1 plus 2.0408%. So when we add up 1 plus 0.020408, raise power the period per year. So when we raise or exponential the period per year, so we get -1. That's a formula for, we already discussed in Introduction to Managerial Finance, this formula for calculating effective annual rate. So this is 1 plus R, which is period rate as this, exponential of the period per, exponential of the period per year, -1, so we get it 23.45. So it's a huge interest rate. So the company benefit when customer choose to forego discount, because the discount what we are offering is having a huge annual rate. Effective annual rate is 23.4%. So the company gets benefit when the customer choose to forego discount and avail the credit for a 45 days instead of making payment before. Now, the length of the credit period influenced by the following factors, that how long you're going to offer them. Now, these are the things that you have to keep it in mind when we are offering some discount or some credit policy. So the first thing is perishable and collateral value. So perishable items have a rapid turnover and low collateral value. So credit periods are therefore shorter, like short credit period, because the product is perishable, like for eatables, like for fruits, vegetables, and these are not possible that you can lend it for a longer period of time. And because as there is no collateral value as well, like this, the item is not there for, if you compare it with the cars or house, that's something very different. Consumer demand, like if the product is in high demand, then the credit sale is not preferable. The seller is not going to be. So high demand product turnover faster and have a shorter credit period. So we see that if the demand is low, then definitely we want to boost our sales and offering on credit as well. Cost, profitability, and standardizations. Inexpensive goods and standardized goods have a shorter credit periods. Like for a small goods, the people are not, because there's a petty, there's a volume is big, but the quantity, the value is small, and the quantity is large. In that case, there is no possibility that we can trace, because that's an expensive to track and trace the customers through for their payment. So for small and petty things, we not involve in the credit type of things. The fourth one is a credit risk. The higher the credit risk, the shorter the credit period is. Uh, Size of the account. Small accounts have a shorter credit period. Large firms, large corporations, when they buy something on credit from other firms, so they definitely get a longer period as compared to the small. The competition. The competition is a very important factor. Like if there is a highly competitive market, everyone is trying to sell. So they find out this that if we sell it on credit, the people are going to buy it. So that's a way that customer type definitely yeah, the different credit terms may be offered to different buyer types, like corporate client or repeated clients or a loyalty customer. So these are the ways that they can differentiate among different customers. Credit policy effects. Revenue is going to affect delay in receiving cash from the sale. May be able to find increase price if we want to sell it. That is also the credit price is different than the cash price, and we see very commonly, like if you go to a dealer, car dealer, they say, okay, if you want to buy on a cash, these are the cash discounts, and if you want to buy on a credit, this is the price. So the prices are different for those who are buying on credit. So may increase total sales. What is the cost effect? These are the revenue effects for credit policy. Cost effects, cost of sale is still incurred even though the cash from the sales has not been received. Uh, Cost of debt must finance receivables, and profitability of non-payments. Some percentage of customers will not pay for the product. And again, this is analysis that what are the effects on revenue side and what are the effects on the cost side. So cost we already discussed. Cash discounts, some customers will pay earlier and pay less than the full sale prices. Now here is an example to understand this whole idea. Your company is evaluating a switch from a cash only policy to a net 30 policy. Like there's a just to pay after 30 days, uh, on 30 days, within 30 days. The price per unit is 100 and the variable cost per unit is 40. The company currently sell 1,000 units per month. Under the proposed policy, the company will be able to sell 1,050. It means that there's an incremental increase in our sales is 50 per unit per month. The required monthly return is 1.5%. So how we can evaluate this, a proposed policy of selling goods on credit. So what is the NPV of this switch? So we have to calculate the net present value of this cash inflow, or the net impact of this credit sale. And should the company offer credit terms of net 30? So what is an incremental cash inflow? The incremental cash inflow is like 100, we're gonna able to sell it at 100. 40 is the variable cost. Fixed cost is not gonna change because this is an incremental sale. So we say that minus 40. And how much is the change? 50 is the unit we are selling, 50 additional unit. 150 minus 1050 minus 1000. So 50 is the additional unit we are selling. And 60 is the incremental cash we are getting is 3000. So incremental cash, what we are getting is 3000. The revenues, the cost is 40 and the revenue is 100. So the net increase is 60 multiplied by the number of units we are selling addition is 50. So by this way, the present value of the incremental cash flow is 3000 because we're going to get it later. So it's 3000 divided by 0.15, 0.15. So we see here that it is 200,000. Cost of switching is 100 into 1000 plus 40 into 1050. Only 1050, so it's going to be 1050 minus 1000, so it's going to be 102. So we are comparing in the net present value of cost and net present value of revenue. So we assuming that this is a beneficial because the net value benefit, net present value of the benefit is 200,000 and the cost is 102,000. So we are getting better off of 98,000. So yes, the company should switch. The total cost of granting credit is the carrying cost. We already discussed in our previous chapter about this carrying cost and storage cost, right? Carrying cost and storage cost. So required return on receivables, losses from bad debts, and cost of managing credit and collection. So these are all the cost attached, which we call it as a carrying cost of selling on credit. And if we are not selling on credit, what cost we can bear is uh, lost sales due to restrict credit policy, and also total cost curve is sum of the carrying cost and the shortage cost. So optimal credit policy is where the total cost curve is minimized, and we see this with this graph. Graph is not appearing here. Yeah, this one. So this U-shaped curve is a total cost curve, and the ideal point is at this point where it is in the minimum. And this minimum point is where the carrying cost is equal to the shortage cost. Other than this point, there is always the total cost is higher. So this is our first part of this chapter.